All right. Hi there. Welcome to Nicholus text classroom. Today we are looking at VAT Part 3. So prior to this session, we would have looked at Part 1 and Part B. So today we are looking to build on that knowledge that we've learned in the prior sessions, right? And I keep on saying building on, right? So remember, you cannot skip anything, right, in this process, all right? All the information that was obviously then shared with you in the previous sessions. It's very important because you need that basic knowledge, right, in order for you to tackle, the other things that follows after that. The more, you know, requiring things, not difficult things. Obviously, you need the basic knowledge in order for you to then understand the other things that requires a bit more in terms of you grasping the information. All right. So without any further waste of time, let's then get into the business of the day. All right. So in terms of what the outline for the session is, we are going to look at output tax. We are going to look at tax levied on importation of services, tax levied on importation of goods, zero-rated supplies, and then finally we'll look at then exempt supplies. Then that would be all for today's session. All right. So when we look at the first three, output tax and tax levied on the importation of goods and services, that is dealt with in terms of Section 7. All right. But obviously you will see when we get to the slide. All right. Okay, so here we are, Section 7, imposition of VAT, right? So the Section 7 deals with the imposition, the charging of VAT, right? So this VAT obviously is an umbrella weight, right? So meaning that there are going to be different VAT that are charged on different transactions, right? So let's look at what Section 7 says in terms of subsection 1. So Section 7 subsection 1 says, they shall be levied and paid VAT. So who levies or charges VAT? Should be the supplier or the seller, right? So the seller, who is a VAT vendor, will levy and pay output VAT. They will charge output VAT on the transaction and pay SARS, all right? Because remember, we always said that the seller is the one that charges output tax, all right? So, but let's not remember in the previous session when we looked at the definition of output VAT, it spoke about only Section 7(1)(a). So meaning the other VAT that are charged in terms of this section, they are not output tax, all right? They are simply VAT on that particular transaction. For example, that would be VAT on importation of goods. It's simply that it's not output tax, all right? So in terms of Section 7(1), we are saying the supplier shall levy and pay VAT on the supply of goods or services by them in the course of furtherance of their enterprise, right? Then Section 7(1)(b) says that they shall be levied and paid VAT on the importation of goods by any person. So any person that imports goods then will need to then pay obviously a tax over to SARS, right? So no one is going to collect on behalf of SARS and paid over to SARS, like when there's a supply of goods or services. Remember, then the seller will then levy and pay that tax, to SARS. But in this case, you as the importer, you will have to pay that tax over to SARS. All right. But normally it would be at obviously the commercial pause. Obviously, when the goods arrive there, then they would say this is the VAT, and then you pay it right there and there. All right. And then when you look at Section 7(c), it says there shall be levied and paid VAT on the supply of goods. Rather on this imported services, right? Supply of imported services by any person. Remember, imported service is it's defined in the Act. So all these services are defined in the Act. So you need to know what is imported services as defined. Firstly, right? So you don't just have to then, whenever you see that there are services that are being imported into SA, and don't just then automatically say, well, there is going to be VAT on these services that has to be paid over to SARS, right? You have to firstly say, but these services that are being imported, are they imported services as defined in terms of the VAT Act? Then you need to go to the definition, right? Then once you are happy that they are imported services as defined, then you will say that, well, then there has to be VAT that is levied and paid to SARS, all right? Sometimes in the scenario, we can already tell you that these services are, imported services as defined, meaning that we don't want you to firstly deal with the definition. We just want you to then deal with obviously then the other tax implications that follow. All right. So I think then we know that in terms of Section 7, right, to say we have output tax, Section 7(1)(a), and then we have tax on the importation of goods and tax on importation of services. All right. So, and I'm just saying the tax. So it's a VAT on importation of services, VAT on importation of goods, not output. But then Section 7(1) is output tax. All right. Then who pays the tax on the above? So in relation to Section 7(1)(a), the output tax, obviously then the vendor supplying the goods or services, they will pay this VAT over to SARS. All right. In relation to Section 7(1)(b), the importation of goods, the person importing the goods has to pay this tax over SARS. All right. And then in relation to Section 7(1)(c), obviously importation of services, the recipient of the services. All right. Then just an admin subsection there, subsection 4, so Section 7(4). If the minister announces a VAT rate change, remember we said the current rate is 15%, but before that it was 14%. So it does happen that the rate changes, right? So when it happens, and obviously if the rate changes, the minister will make an announcement. So when does it become effective? The new rate. So the new rate becomes effective from the date determined by the minister. All right. So it's not the date on which the minister makes an announcement, but rather the date as determined by the minister. All right. Then what are the links of Section 7 and Section 9, 10, 13, and 14? We can refer to the next slides, because when you look at the VAT Act, guys, this act, it's in order for you to deal with a transaction, you need to go to different parts of this act. So basically, a transaction that you need to deal with, obviously, then you need to look at a lot of different sections in order for you to deal with that appropriately. So in essence, VAT is scattered all over that act. So you need to know how to flag properly and obviously cross flag and obviously know how to highlight, right? But we'll deal with these issues in a separate, a session. All right. So in order for you to know how to deal with a transaction properly, you need to know obviously what you are dealing with, basically the issue, right? You need to know, which is basically definitions, which you mostly are in Section 1, right? Then there is one or two definitions that are in other sections in VAT, like your financial services are in section 2, and then when you want to know what is an open market value, you go to Section 3, all right? As just examples of other definitions that are not in Section 1, right? So you need to know what you are dealing with, Section 1 and obviously your Section 2 and 3, and other sections where you would find definitions. Then you need to know the time of supply, which is in Section 9. You need to know the value of supply. So for all other supplies other than importation, all these supplies, the rules of the time of, the value of supply are in Section 10, all right? Just like with all other supplies other than the importation of either goods or services, then the time of supply is in Section 9. So Section 9 and Section 10 deals with time and value respectively of all other supplies other than importation. Then when you deal with importation of goods, then the time and value of supply rules are in section 13. And then when you deal with importation of services, and here we are referring to obviously imported services as defined, then the time and value of supply rules are in section 14. All right. So you need to look at numerous, sections in order for you to deal appropriately with a VAT transaction. All right. So let's look at all these rules. All right. So when we are looking at the supply of goods or services, so we're not speaking about importation, right? Already we've looked at section 7.1 that tells us that obviously then the seller must levy and pay output VAT on the transaction. All right. Then where are the time and value of supply rules? All right. Like I said, they are in section 9 and 10. All right. So the general rule for time of supply is in section 9.1, section 9.1, right? So section 9 subsection 1 says, well, the time of supply is the earlier of the date of invoice and date of payment. All right. So the earlier between those 2 dates. All right. And then the value of supply. So the general rule is sitting in section 10, subsection 2 and 3. So we are saying then the value of supply would be what? The amount of the consideration less VAT. That is the value of supply, right? So value is consideration less VAT. Remember, consideration is defined. We've looked at the definition in the previous session. So you would go to that definition so that you know which amount that you have to then choose in an assessment if you are given different amounts. But if you are given just one amount and it's inclusive of VAT, then you take that amount, you less VAT, then you have your bill of supply, right? Then subsection 3 says, well, consideration is, if we are looking at money, then the amount of such money. But if we are looking at maybe an asset, right? Someone is paying using maybe not money, something other than money, but it has a monetary value. Then obviously you look at the market value of whatever that is then used as a form of payment, right? Then let's then look at importation of goods. So when we come to the importation, so if you are still at an introduction level in your studies or of your studies, then you don't have to worry about section 7.1b and section 7.1c. So you can skip this part of the video, all right? So this one is for people who are at obviously levels other than introduction level, right? So when you're looking at importation of goods, remember we say they shall be levied and paid VAT on the importation of goods, right? In terms of section 7.1b. But then where are the rules for the time and value of supply for importation of goods? So you need to go to section 13, like I said, right? So well, why do SARS want obviously or charges tax on importation of goods? I think we've touched on this briefly in the previous session, all right, when we were looking at definitions, all right. This thing is very simple, all right. SARS is saying, you know what, I want to level the field play or the field of play, all right. So I want to protect, local suppliers, right? So because if your residents or local taxpayers, if they want to source either goods or services, and they have to source them locally from VAT vendors, there's going to be VAT charged on that transaction by the supplier of the goods or services, all right? But then if they then decide to say, well, I want to source these goods or services, abroad, then no VAT would be then charged on that transaction, because the suppliers from these foreign countries are not registered VAT vendors in South Africa. So there will be no VAT on that transaction. So when you compare the two prices of local suppliers who are VAT vendors and suppliers from these foreign countries, then the prices would be different. Obviously the prices from these suppliers from the foreign countries would be lesser compared to the prices from the local suppliers. And just because of the VAT, SARS is saying, well, let's eliminate the issue of VAT, right? Let's eliminate the issue of VAT and ensure that these suppliers these suppliers are on the same position, right? Because the moment we say SARS says, I want VAT if you are importing, then obviously then there will be VAT if you buy locally, and there will also be VAT if you import. So VAT wouldn't be the reason you will have to go and import goods or services to South Africa, all right? So the only reason that should make you to then go and import goods or services should be because, well, the prices that are charged there are competitive. They are lesser than the local prices, not because of VAT. They are just when you look at the prices, excluding the VAT, they are competitive. And then the other reason would be maybe because of the quality that of obviously what you are buying. Then if those are the reasons, then by all means, SARS wouldn't then stop you, all right? SARS is just saying, I want to protect the local suppliers to ensure that VAT is not the only reason that makes, South African citizens to go and then import, either goods or services, all right? So I think that is explained in detail, all right? Obviously, the importer pays the VAT, all right? Um, there are different rules or treatment of importation of goods from obviously your customs union member countries, which is BLNS, Botswana, Lesotho, Namibia, and Swaziland. So if the South African residents obviously import from these four countries, then there is a certain way that you calculate the VAT. And then if they import from, other countries apart from, these customs union member countries, then there is a different way of calculating the VAT, right? So there is no levy of custom duty on imports from BLNS, right? And why is that? This is simply just to obviously then encourage trade amongst these countries. All right. So let's look at the details now. So what is the time of supply when we're looking at BLNS? So we are saying the time of supply is when the goods enter SA. So when the goods enter SA, that is the time of supply. So this is proviso Roman figure 3 to section 13.1. And I'm saying there, just giving a note to say note that not when they reach the importer, all right? So essentially, the moment that the goods arrive at the commercial port, that would be your time of supply, all right? And then what is the time of supply when you import from other countries other than BLNS, right? So the time of supply is when the goods are cleared. So not when they enter SA, when they are cleared, right? So they will obviously arrive at the commercial ports, then they will be inspected, and then obviously VAT will be determined and all that, and then they will be cleared. So when they are cleared and they are ready, obviously, to be then delivered to the importer. If the importer is at the airport, obviously, then they will then get the goods there, right? So at that moment when they are cleared, then that is the time of supply, all right? And then there is some section reference there provided, right? Then what is the value of supply? So when we look at BLNS, and there is a section reference there, the value of supply is obviously when you go to the legislation, this is not obviously put in this manner. It's obviously there you need to read and understand what is said there in words, but those words can simply be summarized as follows. So the value of supply is the custom duty value plus non-refundable import duties and other taxes, right? Then that is your value of supply, right? When you look at other countries, the value of supply is custom duty value plus 10% of the custom duty value, plus non-refundable import duties and other taxes, then you have your value. So you see the difference here now. So when you are importing from BLNS, there is no 10% of that custom duty value, all right? So basically, there's no custom duty that is charged, when you're importing from our customs union member countries, right? So the moment you've determined your value, then you can then apply 15% on the value to calculate VAT. Because remember, this is value, not consideration. If it was consideration, you're going to multiply by 15 over 115. All right. So let's quickly look at an example, a very basic example, right? So a taxpayer imported goods at a cost of 200 and they paid non-refundable import duties of 120 rand, and the goods had custom duty value of 300. So let's look at the solution to see what would be then the VAT there, right? So the VAT on importation of these goods would be, obviously, if you are importing from BLNS, one of the 4 countries, then the customs duty value is 300 there, right? Then you will add import duties. There is no 10% here because import duties are not charged to, when you're importing from one of these 4 countries. Then the value would be 420 rands. All right. Then you multiply by 15% to get to a VAT of 63 rands. All right. Then when we're looking at other countries, the custom duty value would remain 300. All right. Plus 10% of that, which is obviously then the import duties. All right. Plus obviously the non-refundable import duties, all right, of 120, then the value is 450. Then the VAT there on 15% of that, 67.50. All right. Then let's look at services, importation of services, all right? So if this is importation of services, and these are imported services as defined in the VAT Act, then they shall be VAT levied and paid by, obviously, the recipient of these services, all right, in terms of Section 71C, all right? Then what is the time and value of supply, rules? So we need to look at Section 14, all right? So in terms of Section 14.2, the time of supply is the earlier date between invoice date and date of any payment, all right? The value of supply is the greater of consideration and open market value, all right? And then you can get a silk example. Forgot to include the reference there. I've omitted that reference by mistake there, but it's something that obviously then you can comment if you are not able to locate the example in silk, and then I will respond with obviously then example number. All right. So it's very basic example that you can look at. All right. Time of supply, the earlier date between invoice date and payment, and then value of supply is the greater of. So you look at consideration and the open market value, you take the higher amount. All right. Then let's look at then your zero rated supplies, right? Section 11, right? Obviously, the supplies can either be goods or it could be services. All right, we're going to look at both zero rated goods and zero rated services. All right. So remember, I have stated that zero rated items are taxable supplies, right? Although they are subject to VAT at 0%, that is still a taxable supply. All right. So quickly, I'm saying consider the following. A supplier made a turnover exceeding 1 million in a 12 months period, right? So meaning that they need to basically register as a VAT vendor, all right? And they only supplied zero rated goods. So they are taxable supplies, right? So they need to register as a VAT vendor. So is the supplier a VAT vendor? I've already, given out the answer. So yes, they are. Can the supplier claim input VAT? Yes, most definitely, they can claim input VAT. So it is an advantage for you to register as a VAT vendor when you are offering zero rated, items, because remember the VAT that you're going to charge and levy to SAR and pay to SARS, right? It's going to be zero because you're going to see whatever that you're supplying multiplied by 0%. So you're going to pay over output tax of zero to SARS, but you can claim input. Remember, as you purchase, items that you're going to use in your business for the supply of these goods or services, which are taxable at 0%, you will be then you may be then allowed to claim input tax. All right. So you are levying and paying over zero to SARS, and you are claiming amounts, right, in the form of input. So it is a something that is beneficial to you as a VAT vendor, right? Um, Well, zero-rated items are different from exempt supplies because exempt supplies are non-taxable supplies, all right? Basically, no VAT implications arises on exempt supplies, no output VAT, and obviously no claiming of input VAT on exempt supplies, all right? Let's look at then, section 11(1) and 3. This deals with the zero-rated goods, all right? And then section 11(2) and 3 deal with the zero-rated services. All right, so you can see in both section 11(1) and 2, they go hand in hand with section 11(3). Basically, section 11(3) deals with just, documentary proof that needs to be kept and obviously then furnished to SARS. All right. Because definitely for 1 to 0 rate, these items, they have to then provide proof to SARS that these are actually zero rated. All right. And remember, I've discussed this in the first, or part 1 of VAT to say, well, when you look at these, supplies, your taxable supplies and your non-taxable supplies, right? Under taxable supplies, we have standard rated and zero rated supplies. And then your non-taxable supplies, it's your exempt supplies, right? So you shouldn't even try to know all these things off by heart. The only ones that you should know, or if you are allowed or you are in levels where you are allowed to go with your legislations into the assessments, you should know where to find this if you don't know this off by heart. You should know or know where to find your zero rated items in terms of section 11. Definitely telling you the section reference so that you need to know where to go, and exempt supplies in terms of section 12, right? All the other supplies would then be standard rated. You don't need to know those off by heart. All right, great. Then let's quickly look at firstly your zero rated goods, and then we'll look at then zero rated services, right? So we are going to start with exports, all right? So exported goods, all right? So we look at direct exports and indirect exports, all right? So direct exports means you are basically delivering the goods to an export country, right? You are selling to someone who's in an export country and you are delivering to them, all right? So, uh, well, so this is paragraph A of the definition of export. So if you go to definition of export, you will see that this direct export, it's para A of that definition of export. All right. So what are the requirements for 1 to 0 rate? The export of goods to an export country. So direct export. So what are the requirements? So this must be movable goods sold or supplied under a sale or an installment credit agreement. All right. Goods must be exported to an address outside SA. Like I said, direct exports are goods delivered to an export country. So it doesn't come as a surprise that we are seeing this requirement to say the goods must be exported to an address outside SA, right? Export must cover or must occur via a designated commercial port, right? So this is in terms of interpretation note 30, right? The vendor must obtain and retain documentary proof of the export. So section 11.3 and interpretation note 30. All right. And then in terms of what is the deadline for, obtaining of this documentation, that obviously one needs to obtain and retain. So what is the deadline of obtaining this proof? Um, it's 90 days within, right? Documentary proof must be obtained by the supplier within 90 days, right? So what are we saying? So generally, the earlier date between the date of invoice and the date of payment received, but this date must then be within 90 days. If not, VAT must be levied at standard rate. So if you are going to make an export, you must ensure that you obtain this documentary proof within the 90 days as stated, because if you do not do that, then you'll have to basically then standard rate the transaction, right? Obviously, this would then make the sale a bit expensive. So we don't know if then the person who's buying from an export country would still want to buy from you. So it is important that you get the proof within the 90 days as stipulated. All right. Then let's look at indirect exports. Then what are indirect exports? It's goods delivered, or it's when goods are delivered in SA to a non-resident purchaser who exports them, right? So basically this non-resident would be in SA at the time of basically purchasing these goods, and then they're going to live with these goods, all right? So what is going to happen here? What do you think is going to happen? Are you going to zero rate? Because remember, this person is basically buying the goods while they are in SA, even though they are going to live with these goods at a later, time. But at the time of purchase, they are here in SA. So, do you think that there is going to be zero rating of this transaction or not? Right. Basically, the transaction will not be zero rated, but this person, obviously, who is a tourist, for example, coming from a foreign country, will at the time of leaving, when they get to the commercial port, they can basically then claim the VAT that was charged on that transaction. Essentially, then at the end of the day, they wouldn't have paid any VAT. But you, as the supplier, you want to zero rate the transaction, right? But the details are on this next slide. We'll see them and just run through them because I would have then discussed them. Regulation 316 deals with indirect exports, right? So in terms of this regulation, part one of this regulation says that the risk and ownership of transfer is in SA, right? Thus, we charge VAT at 15%. So you're not zero rating. Then the purchaser, who's essentially a tourist, can apply for a VAT refund at the airports, right? But this regulation, when you go to part two of the regulation, it says that the vendor may choose to zero rate the supply at own risk and discretion. So, at the discretion of this vendor and at their own risk, they can choose to zero rate the transaction. Right? So if you are willing to take on that risk, then you can do that. Part two of this regulation does obviously offer you that discretion. Right? So basically, this is an exception to rules in part one. Right. Great. Then we are done with exports, both direct and indirect. So the sale of going concern, right? So the sale of a business or an enterprise as a going concern is a zero-rated supply, all right? This is in terms of section 11(1)(e), all right? So basically, if the parties agree, so who are the parties? The seller and the buyer. If they agreed that the enterprise or part thereof is disposed of as a going concern, then the transaction will be zero rated, right? So this is in terms of section 11(1)(e) and interpretation note 57, right? So what are the requirements for zero rating to apply, right? So basically, before you conclude that the sale of a business is zero rated, you need to firstly test the requirements. So what are these requirements? So the parties must agree in writing that the enterprise or part thereof is disposed as a going concern. The parties must agree in writing that the enterprise is an income earning activity at obviously the date of transfer, and that the consideration includes VAT at 0%, right? And the necessary assets for the carrying on of the enterprise must be transferred, because this wouldn't be an income earning activity if the assets are not transferred. All right. Both the supplier and the purchaser must be registered VAT vendors. So if you meet all these requirements, then the transaction can be zero rated. So the sale of that business or part thereof can then be zero rated, right? So let's just quickly look at specific examples relating to going concern, right? Basically, these examples are aimed at providing guidelines in terms of what constitute an income earning activity. I think that this is the most important important requirement out of all these requirements, right? To say, but um, are they transferring an income earning activity, right? That business that they are selling, is it an income earning activity at the date of transfer? We are not saying at a later date, at the date of transfer, right? So at the date of sale, we need to know if it is an income earning activity. If not, then unfortunately, that transaction cannot be zero rated. So we need to then look at, the VAT implications, right? What needs to be then standard rated, what needs to be zero rated, what needs to be exempted. So you're going to look at the different items, right? Obviously, you have to look at all the assets that are owned by that business or in that business, and then apply different rules to the different assets, right? So, right. Then the examples. Um, Like I said, let's look at specific examples that are aimed at giving a guideline in terms of what constitute an income earning activity, right? So these guidelines are there in interpretation note 57, right? So you just need to then obviously flag that interpretation note, but then obviously you need to go and highlight the important words out there so that these buzzwords can just, when you open the legislation, they just need to pop. You must just see them. The moment you open that note, you must see all these important things. Right. So we're basically saying the mere sale of a business structure will not constitute a selling of an income earning activity when you get to that interpretation note, right? The first example that we're looking at is farming activities. So basically, we are saying the sale of a farm property alone does not constitute the sale of a going concern. So the transaction cannot be zero rated, right? For it to be a sale of a going concern, you must include an income earning activity, right? So you need to sell the farm property together with, things like the crops, equipment, grazing, etc. So all the income earning activities of that farm must then be also sold together with that farm, all right? Leasing activities, we are saying the sale of tenanted property with leasing activities is a going concern, all right? But the sale of residential leasing business is right, not zero rated, all right? Why? Because residential property, residential accommodation is an exempt supply under Section 12C, right? But the sale of tenanted property with leasing activity, not residential, right? So that one there, it's a going concern, all right? So what would constitute a leasing activity? So basically, you're not only selling the property, you are selling it together with, the lease contracts, everything, right? And the tenants. right, then it's a going concern, right? Um, right. Then sale of shares. Obviously, sale of shares cannot be a supply of a going concern. Remember, shares are exempt in terms of Section 10(2)(1)(d) and Section 12, right? Remember, Section 2(1)(d), remember we spoke about this when we were looking at activities that are deemed to be financial services, right? So you would have seen when we got to Section 2(1)(d), we spoke about the issue, the allotment, and what is the other term? So it was the issue and allotment of security, uh, security items, which for example are shares, right? Then dormant business or business yet to commence operations. I think already you can tell that this can be a zero rated, or supply, right? Because the business is not yet operational, right? So you're not selling any income, any activity there. There isn't, right? So the business at a time of transfer is not an income, any activity, right? But it can be zero rated if the supplier is contractually obligated to make it operational, right? So if the supplier, who is the seller, is contracted or they are obligated contractually to make it operational first, then you can apply zero rating, because obviously at the time of transfer or at the first day where the buyer will operate this business, then it would constitute an income, any activity. All right. Other zero rated goods. So these ones are quite straightforward. That's why then there isn't a lot of details under them. So your fuel levy goods in terms of Section 11(1)(h), then basic foodstuff, right? So basic foodstuff in terms of Schedule 2, Part B, right? Obviously, you can refer to the next slide where obviously we are including these basic food items, but obviously this is just for the students who are still at levels where they are not allowed to go in with their legislations into the assessments, because you definitely need to know this off by heart. But for the guys who are taking their legislations into the assessments with, you just need to obviously go and flag, Schedule 2, Part B, right? And then on that flag, you can basically just say basic food stuff, right? And then if you want more details, for me, I would know from that flag that to say these are my exempt basic food stuff, but someone can say exempt and then also say basic food stuff on that flag. All right. Gold coins, they are basically zero rated, or rather, I think I said exempt by mistake there. You would say zero rated, then you say basic food stuff on that flag. All right. Then illuminating kerosene intended for use as fuel for illuminating or heating. Then sanitary towels in terms of Section 11(w). These are zero rated. All right. So then these are the basic foodstuff items that are zero rated in terms of Schedule 2, Part B, right? So brown bread, including brown rolls and buns, brown wheaten meal, maize meal, samp, meal rice, dried mealies, dried beans, lentils, fresh fruit and vegetables, canned vegetables in brine or water only, basically no added sugar, salt, or sauce. Right. You can go through the other items, but essentially these are your basic food stuff. All right. Then let's look at then exported, zero rated services, all right, in terms of Section 11(2), right? Right. So basically, let's start with the general information. We are saying exported services qualify for zero rating, obviously to supply the principle of taxing local consumption only, all right? Because basically the introduction of VAT was basically to tax local consumption only, right? That's why when you export, the items are zero rated. Even goods, right? Goods are zero rated when you export them. So services as well, right? Zero rating applies only if documentary proof is obtained. Interpretation note 31, but also remember section 11.3 because it speaks about documentary proof. Um, Services must be supplied directly to a non-resident and not connected to SA property or consumption. All right. So, firstly, let's look at transport, excluding ancillary transport services of goods or people. So, in terms of section 11.2a, so this is rated if the transport is from SA to abroad, from abroad to SA, or between two foreign countries. All right. So even between those two foreign countries, if this transport is supplied by obviously a South African supplier, it would still be zero rated because it's an export service. All right. Um, then let's look at transport of people. All right. So the first one was transport of goods or people. All right, excluding ancillary transport services. So now section 11.2b looks specifically on transport of people, all right? Zero rated if transport is from SA to SA, right? To the extent that it is by aircraft and it's part of an international carriage, right? Here, an example would be that I am based in Polokwane, right? I want to fly to the USA, all right? So we know there is an airport in Polokwane, right? But this is not an international airport, so I cannot take flights directly from the Polokwane airport to USA, all right? So the Polokwane airport, obviously, I can obviously only take local flights. So in order for me to then fly to the USA, firstly, I have to fly from Polokwane to one of the international airports in SA, for example, OR Tambo in Johannesburg, right? So I would have to then fly from Polokwane to Johannesburg, and then from there on, I can fly from the OR Tambo to the US, right? So that leg from Polokwane to OR Tambo would be uh, zero rated as well, although it's transport within SA, but it is part of obviously an international flight because obviously my intention was always to fly to the USA, not to OR Tambo. So even from Polokwane to OR Tambo, that leg would be zero rated. But definitely the one from OR Tambo to USA, it's zero rated because it is an export service. All right. Happiness. Great. Then transport, including ancillary transport services of goods, right, in terms of section 2C. So this is zero rated if transport is from SA to SA to the extent that the services are provided by the same person as part of the supply of services to which para A or paragraph A applies, right? So which paragraph A are we referring to? The one in the previous slide here. Remember, transport of goods or people. Remember, this excluded ancillary transport services. So the one where we are saying these transport services of goods or people is zero rated if it's from SA to abroad, from abroad to SA, or between two foreign countries. So here in section 11.2c, then we are saying if you are transporting goods, including ancillary transport services, this would be zero rated, right? If this transport is from SA to SA to the extent that, so we are speaking about the SA leg, so in SA, to the extent that these services are provided by the same person as part of the supply of services to which para A applies. Basically, we are saying the transport of those goods in SA, they will be zero rated if they are relating to, right, A here, meaning that this is as part of obviously when you are transporting people, remember people when they are being transported, they would want sometimes they have goods that they are traveling with. So the transport of those goods in SA would be zero rated if obviously these people are going from SA to abroad or from abroad to SA. So they are coming from abroad to SA or between two foreign countries. So if they are traveling in foreign countries, all right. So basically, you are in USA, you traveling to the UK, but then there are goods that needs to be transported in SA. So the transport of these goods, because they are connected to that travel there into foreign countries, the transport in SA would then be exempt. I mean zero rated. But we are seeing to the extent that these services are provided by the same person, meaning that if you are flying, you as a person, you are flying using SAA, these goods that are transported in SA as part of your flight, as part of your travel using SAA, then the goods as well must be then transported by SAA. All right. I'm not sure if it makes sense. So I am traveling to the USA, right? So obviously that transport service by SAA will be zero rated because I'm traveling from SA to USA. All right. So if I have goods that needs to be then transported from Polokwane to OR Tambo then to USA, then these goods, this leg from Polokwane to OR Tambo of these goods that I'm traveling with would also as well be zero rated, right? Because this is part of me traveling from SA to abroad. So if I wasn't going to travel from SA to abroad, then these goods were never going to be then transported from Polokwane to OR Tambo. Right. I hope it makes sense. Great. Then let's look at then other services. The service comprises of, in terms of Section 11(2)(d), ensuring, arranging insurance or arranging transport of passengers or goods to which any of the provisions of paragraph A, B, or C apply. Remember the ones that we've just looked at, all of those, right? So if I'm flying from OR Tambo to USA, right? Remember, in terms of Section 11(2)(a), that service would be zero rated, right? So if now SAA obviously then requires that that travel must be insured, right? That insurance service would then be zero rated as well, right? Because it's connected to that flight from SA to USA, which is zero rated. So this service of insuring then that travel as well would then be zero rated because the travel itself is zero rated in terms of Section 2A. All right. Happiness. Great. And also the service comprises of insuring or arranging insurance of passengers on an international journey provided a single premium is charged for the passengers. Insuring or arranging of insurance of passengers on an international journey. So SAA is insuring, right? So passengers, right, on an international journey. So that service of insuring these passengers, would be zero rated as long as a single premium is paid for the passengers. Happiness, great. Then the service, including ancillary transport service, is transport of goods to a recipient who is not a resident and not a vendor. In terms of Section 11(2)(e), that is quite straightforward. All right. The service of arranging, in terms of Section 11(2)(i), the service of arranging the supply of goods to foreign ships or aircraft or transport of goods within SA, all right, for a person who is not a resident and not a vendor. All right, that is also straightforward. Then municipal rates are zero rated in terms of section 11.2W, right? The zero rating is, however, not applicable where such rate is charged as a flat rate for property rates. All right. Um, all right. So you obviously municipalities must ensure that obviously they don't charge a flat rate, right? So each item must be specified when they are charging, so that then the municipal rates would then be, identifiable. But once they just charge a flat rate, then you won't be able to even determine how much then it's relating to municipal rates. All right. Then in that case, then they wouldn't then be zero rated. All right. Other goods or services such as supplies of electricity, gas, water, drainage, etc., right, must be shown separately. So it makes it easier then for the zero rating of municipal rates. All right. Um, right. Services supplied directly in connection to land or improvements to land, right? If the land is situated outside SA, these are zero rated. All right. Services comprising job-related training of employees, so not educational services. Why are they specifically excluding educational services? Because educational services are exempt. All right. So services comprising job-related training of employees, right? These are exempt in terms of section 11.2R. Zero rated if the training is for the benefit of an employer who is not a resident and not a vendor. Right. So meaning that a local supplier of the services, right? The service being training, right? Is providing this training to employees of a non-resident employer and a non-vet vendor. Then in that case, basically, this would still be what, when you look at the substance of it, this looks like an exported service. So even though the training is offered in SA, right? Even if the employees are in SA, but if it is for the benefit of an employer who's not a resident and not a vet vendor, then this would be zero rated. Right. Um, then financial services, right? So we are going into now exempt supplies. We're done with zero rated supplies. So the first thing there on your exempt supplies is your financial services. Remember when we were looking at definitions in the previous session, we spoke about financial services, and I did mention then that financial services are exempt, right? So here is the confirmation. So in terms of section 12A, right, and then section 2, remember the one that says these are your financial services, all right? In terms of section 12A and 2, financial services, right, are rendered outside SA may be zero rated, right? Well, generally your financial services are exempted, but then now we are speaking about specific things. To say financial services rendered outside SA may be zero rated. And we are saying may, right? So meaning that it could happen that the zero rating doesn't apply, right? Obviously, uh, if I'm the supplier, I would always want them to be zero rated, right? Because financial services are exempt, right? But if they are rendered, you know, outside SA, then they can be zero rated. So you need to choose between exempting and zero rating. For me, I would want to zero rate rather than exempt, because the moment you say this is an exempt supply, then you won't be able to claim any input tax. All right. But the moment you say they are zero rated, then you can claim input tax. So if you say they're exempt, remember you won't levy any output, but also you won't claim input. But the moment you're saying you want to zero rate, you will levy output at 0%, but then you can claim input. All right. So it's more beneficial if they are zero rated rather than exempted. Right. So financial services are exempt services in terms of Section 12A. All right. But if these financial services are rendered outside SA, or basically these services are rendered to a recipient who is not a resident, so they are exported, then you can zero rate them. You may. Zero rating takes priority over exemption, all right? Um, so when it comes to exempt supplies, always be on the lookout of on if or not that those services can be zero rated, right? Because zero rating takes priority over exemption, right? Then, like I said in the prior session, fees relating to financial services are not exempt, so they are taxable. All right. Then let's look at then section 12C, residential accommodation. So basically, we are saying letting of dwelling for residential use is exempt. All right. Basically, residential accommodation. So the supply or provision of residential accommodation is exempt in terms of section 12C. Then when we're looking at employers, we are saying employer provided housing is exempt if occupied as an employment benefit or hostel operated mainly for employees, right? Then that employer provided housing is exempted, right? Then what happens when the accommodation is sold? What happens when the accommodation is sold? Remember, then we are saying the provision of this residential accommodation is an exempt supply. Basically, when you are charging rental, that rental would not include, VAT implications. All right, and other services that you provide as part of this renting out or letting of this accommodation, you won't be able to claim input because basically then you are supplying exempted services, right? The renting or the letting of residential accommodation. So now when you come and sell the accommodation itself, the property, so what will happen then? Obviously, there won't be any VAT implications, right? Because remember that accommodation is it's still an exempt supply, and this obviously is excluded from an enterprise definition, right? Then public transport by road or rail for fare-paying passengers. This is exempt in terms of Section 12G, all right? Except if zero rated. Like I said, always check if that exempt supply is possibly zero rated, because zero rating would take priority. All right. Educational services by schools or universities, right? These are exempt in terms of Section 12, Figure 1. And then educational accommodation. So we are speaking about, firstly, they are about the services, right? So then now we are speaking about accommodation, because remember, universities, for example, they would provide both the educational services, right? Obviously, which would be, the programs that you are enrolling for, right? And all the services that are related to that program, like the lectures that you need to attend. Obviously, you pay for the modules and all that. So obviously that the payments for these modules would not include VAT, and any other services that are provided by the university would not include VAT, because they are basically exempt supplies in terms of Section 12, Roman figure 1. But then Roman figure 2 deals with the accommodation. So those services excluding accommodation. So also then, if accommodation is provided, then this would be exempt. All right. But then what happens if the institution doesn't own the accommodation? Because it does happen that some other institutions do not own, the accommodation, right? So basically, they are renting the accommodation from someone else, and then now they supply uh, obviously that accommodation or housing to students, right? So what happens there? Obviously, the person who's supplying, who owns this accommodation, the accommodation would be commercial accommodation. So they are going to, levy VAT on the transaction, right? So the rentals that they are charging to the institution would include VAT implications, right? But the institution would not levy any VAT on any rent that it charges to the students, because now this accommodation in the hands of the institution would then constitute residential accommodation, or basically you could say residential accommodation, but it is an educational accommodation to be, technically correct. Because the moment you say residential accommodation, you might want to then exempt it in terms of Section 12C, but that wouldn't be technically correct. The technically correct reason would be that this is educational accommodation, because now it's provided by the institution to students. Then you exempt it in terms of Section 12H, Roman figure 2. All right. Membership fees of employee organizations. All right. They're exempt in terms of Section 12I. All right. Then childcare services by creches and after school centers is exempt in terms of Section 12J. All right. And then this brings us to the end of the session. All right. I think by now you are really, uh, building your vet knowledge. I think uh, I would be happy if by now you are saying, you know what, I've looked at all the parts that are covered up to this point, part one to part three, and you know what, I feel very confident about my vet knowledge. All right, because all these are going to be crucial in the next sessions. All right. So I think not to prolong the video, so I'm going to end the video here. Remember to like, subscribe, and obviously share, so that we can have more people who are tuning in, and obviously then they can benefit from whatever we've started here, right? I think we are going to create something very, very, very big, right? So I'm going to call it a day and end it here. Thank you very much for tuning in. I will see you in the next session. Bye bye.